Before we begin, this video is for educational purposes only and is not financial advice. Always do your own research before making any investment decisions. Most beginner investors don't lose money because they picked the wrong stock. They lose money because of simple, avoidable mistakes that nobody warned them about. In this video, I'm going to walk you through the 5 biggest investing mistakes beginners make, and more importantly, exactly how to avoid every single one of them. If you're just starting out, this video could save you thousands. Let's get into it. Mistake number 1, and probably the most common one, is waiting for the perfect moment to invest. You've probably heard people say things like, "I'll start investing when the market calms down," or "I'll wait until after the election," or "I'll invest once things feel more stable." Here's the truth. The perfect moment to invest does not exist. There will always be uncertainty. There will always be something happening in the world that makes investing feel risky. War, inflation, interest rates, recessions. There is always a reason to wait if you're looking for one. And while you're waiting, time is passing. And time is literally the most valuable asset in investing. Here's a simple example. 2 people both invest €200 a month into a global ETF earning 7% per year on average. Person A starts at age 25. Person B waits until age 35, just 10 years later. By age 65, person A has around €525,000. Person B has around €243,000. Same monthly investment, same returns. The only difference is 10 years of waiting. That gap, over €280,000, is the real cost of waiting for the perfect moment. The market will go up and down. That's guaranteed. But historically, over long periods of time, it has always gone up. The best strategy for a beginner is simple. Start now with whatever you have and keep going. Mistake number 2 is panic selling when the market drops. Markets go down. This is not a possibility, it is a certainty. Every single year there are dips, corrections, and crashes. Sometimes small, sometimes dramatic. In 2020, during COVID, global markets dropped around 30% in just a few weeks. Millions of beginner investors saw their portfolios turn red and did the worst possible thing. They sold everything to stop the bleeding. And then the market recovered. Within a year, it had not only recovered, but hit new all-time highs. The people who panicked and sold locked in their losses permanently. The people who held on, or who kept buying during the dip, came out significantly ahead. Here's the key mindset shift you need. A drop in your portfolio is only a loss if you sell. If you don't sell, it's just a temporary number on a screen. Your ETF still holds the same companies. The global economy is still running. Nothing has fundamentally changed. When you see red in your portfolio, the question to ask yourself isn't, "Should I sell?" It's, "Do I still believe the global economy will be larger in 20 years than it is today?" If the answer is yes, and historically it has always been yes, then you hold. You don't panic. You trust the process. Mistake number 3 is putting too much money into one thing. This might be a single stock you read about online. It might be one sector, like tech or crypto. It might even be your employer's stock, because it feels familiar and safe. The problem is concentration risk. When you put a large amount of your money into one asset, you're betting everything on that one thing performing well. And even the best companies in the world go through terrible years. Even entire sectors collapse for extended periods. We talked about ETFs in our last video, and this is exactly why they're so powerful for beginners. A global ETF like the MSCI World spreads your money across 1,500 companies in 23 countries automatically. No single company makes up more than a few percent of the whole fund. If one company completely collapses, your overall portfolio barely feels it. Diversification doesn't guarantee profits, but it dramatically reduces the risk of a single bad event, wiping out a large chunk of your savings. A simple rule of thumb: no single stock or asset should make up more than 5 to 10% of your total portfolio as a beginner. If you want to invest in individual companies on top of your ETF core, keep it small and treat it as the high-risk portion of your portfolio. Mistake number 4 is ignoring fees, and this one is sneaky because the numbers look so small on the surface. Let's say you invest 10,000 euros. Fund A charges a 0.2% annual fee. Fund B charges 1.5% per year. That's just a 1-3% difference. Barely anything, right? Wrong. Over 30 years, assuming 7% annual growth, Fund A grows to around 71,000 euros. Fund B grows to around 50,000 euros. That 1.3% fee difference costs you over 20,000 euros from the same initial investment. Over time, fees don't just cost you money, they cost you compounding. Every euro paid in fees is a euro that isn't growing for the next 30 years. This is why index ETFs are so attractive. Their fees, called the TER or total expense ratio, are typically between 0.7% and 0.25% per year. That's almost nothing. Actively managed funds, on the other hand, often charge 1% to 2% per year. And study after study consistently shows that the vast majority of these funds fail to beat simple index ETFs over the long run. You're paying significantly more for worse results. Always check the TER before buying any fund. Keep it under 0.25% and you're in good shape. Mistake number 5 is investing money you might need in the short term. Investing works because of time. The longer your money is invested, the more it can grow and recover from inevitable dips. But if you invest money you actually need in 6 months, for rent, for a car, for an emergency, you might be forced to sell at exactly the wrong moment. Imagine you invested your emergency fund in early 2020, right before COVID hit. The market dropped 30%. Then your car breaks down and you need that money immediately. You're forced to sell at a 30% loss with no choice. This is why every financial educator recommends building an emergency fund before you start investing. Typically, 3 to 6 months of your monthly expenses sitting in a regular savings account or a high-yield savings account where it's safe, accessible, and not exposed to market volatility. Once that safety net is in place, the money you invest is truly long-term money. Money you don't need to touch for 10, 15, 20 years. And that time horizon is what allows you to ride out crashes, benefit from compound growth, and actually build wealth. The rule is simple. Never invest money you can't afford to forget about for at least 5 years, ideally much longer. So to recap, the 5 mistakes beginners make are waiting for the perfect moment, panic selling when markets drop, failing to diversify, ignoring fees, and investing money you can't afford to lock away. Avoid these 5, and you're already ahead of the majority of beginner investors. If this video was helpful, subscribe to SimpleWealth. We break down investing in the simplest way possible every single week. Drop any questions in the comments, and we'll see you in the next one.